Hey everyone, welcome back to the channel. If you're thinking about tapping into your home's equity, you've probably come across two very popular options, HELOC and cash out refinance. But which one is better for you? Which one makes more sense? Today we're diving into this ultimate battle to help you figure out once and for all HELOC versus cash out refinance. What's the difference? And more importantly, which one should you choose? I mean, it's kind of like trying to decide between two superhero tools. You've got the HELOC. Think of it as your trusty sidekick, ready to swoop in when you need a quick cash boost. And then there's the cash out refinance, the big powerful tool that can help reshape your financial future. But which one should you be using? Before we dive into the details, be sure to hit that like button, subscribe if you haven't already, and tap that notification bell so you never miss out on videos like this. Oh, and don't forget to share this with a friend who's also thinking about tapping into their home's equity. They'll thank you later. All right, let's get to it. HELOC versus cash out refinance. It's time to break it down. First up, let's talk about the HELOC, which stands for Home Equity Line of Credit. A HELOC is essentially a revolving line of credit that allows you to borrow against the equity in your home up to a certain limit. Think of it like a giant credit card using your home as collateral, but with a much lower interest rate than a traditional credit card. It's like having a superpower to pull cash out of your house whenever you need it, just without the flashy cape and the cool theme music. So let's go over the basics of a HELOC, revolving credit. A HELOC is a line of credit. This means you get access to a certain credit limit, and you can borrow and repay as needed, kind of like using a credit card but with a much lower interest rate. Draw period. Most HELOCs come with a draw period, usually 5-10 years. During this time, you can borrow from the line of credit, and typically you're only required to make interest payments. This gives you flexibility, but you'll still need to repay the principal eventually. Repayment. After the draw period, the loan enters the repayment phase, where you'll have to start paying back the principal as well as the interest. This phase could last anywhere from 10 to 20 years. Interest rates. Most HELOCs come with variable interest rates, meaning the rate can change based on market conditions. The good news? They usually start lower than a traditional mortgage or credit card rate, but before you rush out to get one, let's talk about some pros and cons. Flexibility. You only borrow what you need, and you can pay it back at your own pace during the draw period. Lower interest rates. Since your home is being used as collateral, HELOCs often offer much lower interest rates than unsecured credit options like personal loans or credit cards. Tax deductions. In some cases, the interest paid on your HELOC might be tax deductible if it's used for home improvement. Check with your tax advisor on this one. Now let's get to the downsides of the HELOC, because we all know every superhero has a flaw. Variable interest rates. While low at first, the interest rate can go up, so it's important to be ready for that. Risk of foreclosure. Since your home is the collateral, failing to make payments could result in foreclosure. Yikes! Debt creep. Because you're only required to pay interest at first, it can be easy to carry a balance longer than expected. So, careful with the spending. That's the HELOC in a nutshell. Flexible, easy to use, but it requires careful planning. Alright, now let's talk about the cash out refinance. This one's a little different. Instead of just opening a line of credit, with a cash out refinance, you essentially refinance your existing mortgage for more than you currently owe and take the difference in cash. So if you have a $100,000 mortgage and your home is worth $200,000, you could refinance for $150,000, paying off your old mortgage and getting $50,000 in cash to do whatever you want. It's like saying, I want to refinance but with a side of cash, please. It's a powerful tool, but it comes with some considerations. Here's how a cash-out refinance works. Refinance your mortgage. You'll be refinancing your original mortgage, which means you're taking on a new loan. This is a good option if you're looking to consolidate debt or if you need a larger lump sum of cash for home improvements, investments, or other big expenses. New loan terms. The new mortgage will come with its own terms, interest rates, loan period, and monthly payments. These terms could be better or worse than your old mortgage, depending on the market. Fixed or variable rates. Unlike HELOCs, cash-out refinances often come with fixed interest rates, which means your monthly payment will stay the same throughout the life of the loan. This could give you more stability. Now let's look at the pros and cons of a cash-out refinance. Lower interest rates. Cash-out refinances typically come with lower interest rates than personal loans or credit cards. Larger lump sum. You can take out a larger amount of money compared to a HELOC. If you have significant equity in your home, this could be a big plus. Fixed rates. With a cash-out refinance, you usually get the stability of a fixed interest rate, which is great if you prefer predictable monthly payments. Now let's not get too carried away. There are some potential drawbacks here as well. Closing costs. Just like when you originally bought your home, refinancing comes with closing costs. You could be looking at anywhere from 2% to 5% of the loan amount in fees. Longer loan terms. With a refinance, you may end up extending the length of your mortgage, which could increase your total interest payments over time. Risk of foreclosure. Again, since your home is the collateral, missing payments could lead to foreclosure. Make sure you're ready to take on a larger loan. Now that we've gone over both options, let's talk about the big showdown: HELOC versus cash-out refinance. So which one should you choose? Well, it all depends on your goals. Let's break it down. If you need flexibility, if you want the ability to borrow and repay as you need, maybe for a series of smaller expenses or home improvements over time, the HELOC is a good choice. You only pay interest on what you borrow, and you get to access that line of credit whenever needed. If you need a lump sum. If you have a specific need for a large amount of money all at once, like paying off high-interest debt or funding a major project, the cash-out refinance could be the way to go. Plus, if you want the stability of a fixed interest rate, this might be your best bet. So if you're looking for flexibility and the ability to tap into cash when needed, the HELOC is like the Swiss Army knife of home equity. But if you need that big chunk of cash and want to lock in a stable payment, the cash-out refinance is like a power tool that gets the job done. So there you have it, HELOC versus cash-out refinance. Two powerful ways to tap into your home's equity, but they each have their own pros and cons. The key is knowing which one fits your needs, goals, and financial situation. If this video helped clear up the confusion, hit that like button, subscribe to the channel, and don't forget to share this video with a friend or family member who's thinking about tapping into their home's equity. Trust me, they'll thank you for it later. Thanks for watching. Now go ahead and make those smart financial decisions. Your future self will thank you.